Sharpe Ratio versus Calmar Ratio. Which one truly measures trading success? The Sharpe Ratio is popular in finance for evaluating risk-adjusted returns, but it has several limitations when it comes to measuring trading performance. A better alternative is the CAGR to maximum drawdown ratio, also known as the Calmar Ratio, which provides a more practical and reliable way to assess trading strategies. The Sharpe Ratio assumes that returns follow a normal distribution, but real-world scenarios often deviate from this assumption. For example, many hedge fund strategies exhibit returns with fat tails or skewness due to concentrated bets or exposure to rare events. A volatility selling strategy, such as selling options, might generate small, consistent profits but carry a significant risk of catastrophic loss during a market crash. The Sharpe Ratio would fail to capture this risk appropriately. It also focuses solely on volatility as a measure of risk, ignoring other critical factors like liquidity risk or tail risk. For instance, in March 2020 during the COVID-19 market crash, liquidity dried up in certain asset classes, leading to massive price swings. A strategy heavily reliant on illiquid assets might appear stable under the Sharpe Ratio but carry hidden risks that manifest during such events. The Sharpe Ratio assumes that the characteristics of risk and return stay constant over time, which isn't realistic given how markets change. A momentum strategy might perform well in a trending bull market but struggle during sideways or volatile conditions. The Sharpe Ratio often overstates its robustness because it doesn't account for these shifts. Another issue is that the Sharpe Ratio can be manipulated. Adjusting the time period or using leverage can inflate the ratio and make a strategy appear better than it actually is. For example, a trader could analyze performance during a bull market only, showing inflated returns with minimal volatility, while ignoring periods of significant drawdowns. Even the choice of the risk-free rate introduces subjectivity. Using the yield on a 3-month Treasury bill versus a 10-year Treasury bond could lead to very different Sharpe ratios for the same strategy. Lastly, it emphasizes average returns, which can mask variability. For example, a strategy with 3 years of 20% annual returns followed by a 4th year of 60% would have a similar average return to a more consistent strategy returning 5% per year. However, the former carries significantly higher risk, which the Sharpe Ratio doesn't reflect well. In contrast, the CAGR to maximum drawdown ratio focuses on drawdowns, which is one of the most critical aspects of risk in trading. By incorporating maximum drawdown into the calculation, it provides a clear view of how much risk is involved in terms of potential losses. For example, a strategy that grows at a CAGR of 15% but experiences a maximum drawdown of 50% will have a Calmar ratio of 0.3, while a more stable strategy with a CAGR of 10% and a drawdown of 10% will have a much higher Calmar ratio of 1.0. This makes it easier to compare the sustainability of different strategies. This metric also uses the compound annual growth rate, which gives a long-term perspective on returns relative to risk. For example, a buy-and-hold portfolio of the S&P 500 might have a CAGR of 8% with a drawdown of 55% during the 2008 financial crisis, resulting in a Calmar ratio of approximately 0.15. Meanwhile, a well-constructed algorithmic strategy with a CAGR of 12% and a drawdown of 20% would yield a much more favorable Calmar ratio of 0.6. The Calmar ratio is straightforward. It tells you how much return you're getting for each unit of risk. This makes it easier to compare strategies and identify the ones that balance returns with the potential for significant losses. For example, if two strategies both have a CAGR of 15%, but one has a maximum drawdown of 10%, Calmar ratio equals 1.5, while the other has a drawdown of 40%, Calmar ratio equals 0.375. The former is clearly the better choice for risk-averse investors. Unlike the Sharpe ratio, the Calmar ratio adjusts as market conditions change, making it more adaptable and useful over time. For example, during periods of heightened volatility like the 2022 bear market, the Calmar ratio would naturally reflect any increase in drawdowns, providing a more realistic picture of strategy performance. For trading systems, a Calmar ratio of 1.0 or higher is often considered a good benchmark, especially when accounting for market downturns like the 2008 financial crisis or the COVID-19 crash. For instance, a trend-following system that managed to preserve capital during the 2020 market crash by cutting losses early might achieve a high Calmar ratio, making it attractive to investors focused on risk management. It's also worth noting that the Calmar ratio isn't meant to replace other metrics entirely. Instead, it works well alongside measures like the Sharpe or Sortino ratios to give a more complete picture of a strategy's performance. For example, combining the Calmar ratio with the Sortino ratio could help investors differentiate between strategies that avoid large drawdowns and those that optimize for upside potential while controlling downside risk. While the Sharpe ratio is widely used, its limitations make it less suitable for evaluating complex trading strategies in real-world markets. The Calmar ratio, by focusing on drawdowns and long-term growth, provides a clearer and more practical measure of performance. Its adaptability and focus on risk management make it a valuable tool for traders and investors who prioritize capital preservation and realistic assessments of risk-adjusted returns. Combined with other metrics, it gives a more comprehensive view of trading performance and supports smarter decisions.